Good afternoon, everyone. I'd like to welcome everyone to the webinar titled Reduce Your Risk and Export Fearlessly with the Exim Bank. Today's webinar is sponsored by SCAR-U. Scarborough University was founded in 2006 with a mission to provide necessary, relevant, and continuing education to Scarborough employees, clients, and professionals engaged in international and domestic trade and logistics. My name is Kevin Ekstrand. I'm a licensed customs broker and a certified customs specialist. I have the privilege of being the Vice President of Sales and Marketing for Scarborough International. This is an interactive webinar, and we are here to answer your questions, so please submit questions. You will find the Q&A button at the top of your screen. Your question will appear for the audience to see, so you may choose to show your name or be anonymous at your own discretion. I ask that you start submitting your questions right now. I know we've already got one posted up there that was submitted at login. Please also note that you can easily adjust your windows. Please click on the top of the video portion to maximize or minimize this piece of the webinar. So while you're adjusting your screens and posting your questions, I'll take a minute to introduce you to Scarborough. Scarborough is a full-service logistics company that has been operating for over 31 years. We are headquartered in the heart of America, Kansas City, where faith, family, and hard work make for a great organization. We also have offices in Chicago, St. Louis, Des Moines, New York, Dallas, Laredo, Nuevo Laredo, Mexico, and Shanghai, China. Beyond our own offices, we are part of a network of companies that puts us in every country around the world. We are truly a great partner to our clients. We collaborate, stand by their side, and actively participate in their growth opportunities by helping them navigate import and export regulation around the world. We value each and every partnership, along with each and every relationship we build along the way. As always, I would like to thank you for being here today. To our many clients on the call today, thank you for your partnership. If you are not yet a Scarborough client, we welcome an opportunity to earn your trust and partnership. Now, let me introduce to you our presenter today. We are very honored to have our client with the Regional Director for the Export-Import Bank of the United States of America, joining us today from a trade show in Las Vegas, of all things. So, Mike, thank you for getting away, or Mark, from putting it on red and presenting today's information. I will go ahead and turn this over to you.
Thanks, Kevin, and thanks, Scarborough, for letting me present this to you today. And we might have a little bit of background noise, but I think we'll be okay, and we'll make our way through it. I am the regional director responsible for a good chunk of the Midwest. I cover Ohio, Kentucky, Missouri, Kansas. Our central region covers 19 states, all in all. So my plan, the way I hope to work through this is I've been doing this enough to know that there's a good portion of the folks that are on the line that have absolutely no idea who Exim Bank is, what we do, never heard of this bank. So the first thing we're going to do is we're going to talk a little bit as far as what is Exim Bank, what is an export credit agency, what is export credit agency financing, and then we'll kind of dig a little bit more into the details of some of the products and services that we offer. I like this slide. This is kind of my intro slide because you'll hear a lot of different agencies talking about how we need to help companies grow their exports. There's a lot of different agencies. There's myself, there's the SBA, there's the U.S. Commercial Service. There's a lot of government agencies that tackle this. How can we help grow exports? And this slide is the best example for why. We are ranked 144th in the world if you compare our exports to our gross domestic product, to our GDP. Gross dollar amounts were, depending on who you listen to, we're either the second or the third. China's number one. They're the gross dollar amount. They're exporting the most. Germany and the U.S. were kind of back and forth as far as 2 and 3 goes for gross dollar. But as a percent of GDP, 144th, we're right in between Rwanda and Haiti. This is March Madness season, so safe to say if you're ranked 144th, you're not going to the NCAA tournament. You're probably not going to get an NIT bid. Your coach has already been fired. The recruits are not returning any phone calls. And probably the chancellor of the university is really wondering whether or not you need a basketball program at all if you're ranked 144th. So that's kind of why we do what we do, and that's why we try to to help both small businesses, medium-sized businesses, large businesses. It's all about exports. So who is the Export-Import Bank? We are the official export credit agency of the United States. And let me talk about export credit agency for a minute, because that's a term that not a whole lot of companies are familiar with. There are roughly 85 export credit agencies throughout the world. Every developed country has their own ECA, or their own Exim Bank, if you will. All your developed countries have one. Most of your developing countries have them. Nigeria, India, Russia, China, all have Exim banks. It's all about access to capital. It's what we can do in addition to the private sector to make sure that there is enough capital in the markets so that companies can buy U.S. made stuff. That's what I'm all about, is I want to make sure that there's capital out there so that companies outside the U.S. can buy U.S. made stuff and services. That's what EDC Canada is doing. My counterpart in Canada, they're just taking it from a Canadian perspective. They want to push Canadian exports. UK Export Finance in Great Britain, they want to push stuff and services made in the UK. So that's what ECAs are. So if you ever hear the term ECA financing, just think that's kind of what all these different Exim banks around the world are doing. We've been around since 1934, 82 years. We are an executive branch agency. We're based in DC. I'm in the regional office. I'm based out of Chicago, and like I said before, I cover 4 states primarily. I piggy bank a couple other states. We're a small agency. We are less than 500 employees. Kind of makes us a little bit unique as far as government agencies go. And more importantly, we are self-sustaining and independent. What does that mean? It means that we are not a burden to taxpayers. We actually make money. Government agencies typically can't say that. As a matter of fact, they're so rare for government agencies to be profitable that there is not a term for profit in government accounting. We're officially what's called a negative subsidy agency. In 2015, as you can see on the slide, a little $425 million in profit or negative subsidy. 2016, it was a little over $250,000. Our record year was in 2013, where we earned a profit or negative subsidy of a little over $1 billion. So the government agency actually makes money. The Treasury Department really likes that because they don't let us keep the money that we make. We have to turn it all back over to them, and then they help fund other non-negative, or actually what we call positive subsidy agencies, like the post office. So you can think of Exim Bank as keeping your postage a little bit cheaper, I guess. One of the myths out there as far as Exim Bank goes is that if you are not a big business, you have no place with Exim Bank. You couldn't be farther from the truth. 90% of the number of transactions that we touch on a regular basis are for small business. No transaction is too small. No transaction is too big for that matter, but the small one is the one that most companies don't understand. These a couple examples. The first one on the left, that's some textbooks. I believe that went to India, and that invoice was under $10,000. The middle one was some hair care products that left the West Coast, went to Russia. That was under $10,000. And my little guy on the right there, that was some medieval garb, live action role play, Renaissance fair costumes that were manufactured here in the U.S., and they were exported to Western Europe for a big medieval fair they were having. I believe that invoice was actually under $5,000, and we helped with that. So just remember that if you do hear of Exim Bank, and we get lumped in with Boeing and Caterpillar and GE, which fantastic, love those guys. But big business isn't all that we do. We do a lot of stuff to support small business. So that's kind of ECA financing, our big picture. Who Exim Bank is, kind of the next picture. Now what I'm going to do is I'm going to drill into what our three core products. What are those core products that Exim Bank offers to help with that access to capital that I mentioned earlier on? So this first one is what we call the working capital loan guarantee. It's what I call a bank product, because what we do with the working capital loan guarantee is we work with your bank. Could be a small bank, could be a larger bank. We can work with any size bank. And what we do is we provide a guarantee to your bank so they can make an export line of credit to you. If your bank is not comfortable with your export model, there's not enough assets to support what you need to do to grow your exports, they can come to us. The SBA also has a program, and I'll kind of speak to that a little bit in a minute or two. But the idea there is that your bank is going to do what your bank does best. They're going to lend you the money. They're going to manage that. They're going to collateralize that. But at the end of the day, either Exim Bank or the SBA, we provide a 90% principal and interest guarantee to your bank. That makes a banker very happy when they know that they can make a loan, and at the end of the day, they have transferred all but 10% of the risk over to the federal government. So, talking about the SBA. The SBA can do up to $5 million on these. So in a lot of cases for small businesses, the bank will work with the SBA, and they will make this guaranteed line of credit. I can work with any size loans. So I can do the ones over $5 million. I can do the ones under $5 million. The good news is as an exporter, you could care less, because you're still going to go to your bank, and whether that bank uses the SBA guarantee or the Exim Bank guarantee, at the end of the day, you're still getting a loan to grow your exports. Standby letters of credit. Boy, that's kind of those can be tricky sometimes. That's if you, capital equipment manufacturer, you ask for a cash down payment, your company, your buyer agrees to it, but they want a standby to come back to make sure that they get their cash down payment back if something goes wrong. Standby letters of credit are, they're a bank product, but they are 100% collateralized, which means that if you get a $100,000 down payment from your customer and you have to issue a $100,000 standby, that bank is going to want that $100,000 to collateralize it. It's a dollar for dollar collateralized product. It doesn't really help you. You got the, the down payment to help you put your production in place, but you have to turn right around and give that back to a bank. So the neat thing is under our working capital loan guarantees, both mine and the SBA's, those standby letters of credit only have to be collateralized at 25%, and in some cases down to 10%. So you get that $100,000 cash down payment instead of having to give that over to your bank for them to issue a standby. If it's 10% collateralized, you only have to give them $10,000. They use $10,000, they collateralize that $100,000 standby issuance. You then have that other $90,000 to do exactly what you're supposed to do with it, which is start the production process. So that's a real benefit when you're dealing with the SBA and the Exim working capital loan guarantees, is that reduced collateralization for standbys. There is, if you note at the bottom, I'm not going to launch it, but there is actually, we have a YouTube video. You can go to our website, www.exim.gov, and there'll be a couple of videos. I'm going to point out a couple of these as we go, but this is a real nice, simple, I think it's a 90-second video that kind of summarizes how this working capital loan guarantee works. This is what we call a borrowing base. And if you are a company that on a monthly basis you have to complete a borrowing base certificate, you're going to know exactly what I'm getting at here. On the left-hand side of the screen, this is assuming that you have $2 million worth of working capital type assets to secure a line of credit. Left-hand side, this is your typical borrowing base with your bank. They're going to take that $2 million in collateral, and they're going to make $760,000 available to you to buy your material, production, all that kind of good stuff. Under mine or the SBA's products, that's on the right-hand side, you will notice same $2 million worth of collateral, but instead of $760,000 in availability, you'll get 1.650. You're going to get over $1.5 million in availability versus $760,000. How do we do that? Higher advance rates. You'll notice that we'll give 75% advance rate on raw materials, work in process, finished goods, higher advance rate on your foreign accounts receivable, and it's really that work in process, that 75% advance on WIP versus zero. Most banks will not lend you a dime on work in process for the simple fact that if they have to step in, what are they going to do with a half-finished piece of equipment? It's a boat anchor. So that's why they don't lend against that. But when you have a government guarantee in place, now I'll lend 75% on that WIP. So if you have if you're making something that, a piece of equipment that maybe takes you 16, 18, 20 weeks from the time the raw materials come in the back door to when the finished product goes out the front door, that's 16, 18 weeks that product on your factory floor is a dead asset. You can't borrow against it. It's just sitting there. It's not working for you. Under the SBA or the Exim deal, if that piece of equipment is going to be exported, we can actually allow 75% advance rate against that. So I have a lot of companies, manufacturers, that's why they do this. They love this product. It gives them a lot more availability on the assets that are already there in their factory. It's just giving them a whole lot more borrowing power. So that's working capital. I refer to that as a bank product, just for the simple fact that it's usually this isn't something, I don't lend the money, the SBA doesn't lend the money. This is something to where if your bank is looking for a way to make the deal, they will reach out to the SBA or Exim because it's that 90% principal and interest guarantee back to them. Now, the next two products I'm going to talk about, these are more of a U product, not necessarily a bank product. This is the first one is export credit insurance. This is without a doubt our bread and butter. The idea behind export credit insurance is most U.S. exports, and I've been out at the trade show this week visiting with, this is the big ConExpo ConAg show out in Vegas. I think they're estimating about 150,000 in attendance. This is a big deal. This is all of your large equipment manufacturers, from concrete to asphalt to agriculture equipment. This is a big deal. And most of the buyers I've talked to, most of the companies that are manufacturing the product, their exports are typically, I get cash up front. I will not export until that wire transfer hits my bank and I'm paid in full. Maybe I'll accept a letter of credit. I don't really like letters of credit, but I'll accept them if that's the only way I can make a deal. I'm an alternative to that. If you can't get cash up front from your customer, and or they can't obtain a letter of credit from their bank, and I'll kind of talk about that here in a second, we can step in and basically say, hey, there's another way to look at it. You can actually offer open account terms on that, export the product to them, give them 60, 90, 120 days to pay. That usually scares the heck out of U.S. companies when I bring it up. I can actually see these guys as I'm walking the trade show floor. They actually break out in a cold sweat as I start talking about this. But I say you can offer open account terms because I'm going to step in with an insurance product. I'm going to mitigate all but 5% of your risk through one of my programs, to where if you don't get paid what's owed to you at the time of export, you're going to file a claim with me. You're going to get 95% of what's owed to you. So they're still sweating. Don't get me wrong. It's not that I've taken I haven't completely taken the fear out of their mind, but it's another way to look at things. Cash up front, if you can get it, I'm not going to tell you to change a thing. Cash is king. If you can get the cash up front, keep getting the cash up front. Letters of credit, a little bit about those. They're getting tough. They're getting tougher and tougher for foreign buyers to obtain. They're a little bit pricey for both you and for your customers. And the reason it's getting tougher and tougher for them to get is that a lot of the banks outside of the U.S., not real liquid at this point in time. Kind of think the way our banks were 2008, 2009. Not really happy about lending money. Well, that's kind of what's going on outside of the U.S. Banks aren't liquid. They're not real comfortable issuing letters of credit. It is a collateralized product, just like the standby that we talked about. If you're going to issue a commercial letter of credit, it is dollar for dollar collateralized. So that's a little bit of a problem. So there again, this is an alternative. You're going to be able to give your foreign buyers the ability to take the product, take possession of the product. If you're working with distributors, this is the greatest thing they've ever heard of, because ideally in a distributor model, they're going to take possession of your product, on-sell it, get paid from their customers before they ever have to pay you. It doesn't. They are never in a negative cash flow position. So that's their ideal world, and that's what this enables them to do. So your buyers are going to love to hear about it. I have a lot of companies that use this as a means to enter new markets. It's real easy when you're entering a new market when you can come right out of the gate offering open account terms and not talking about cash up front or letters of credit. And the third point, the financing tool. Foreign accounts receivables will scare your banker to death. They don't want to hear about them. They definitely will not allow you to include them in the borrowing base until you insure them. And if you get them insured through either Exim or some of the private carrier companies out there that offer export credit insurance, once those foreign accounts receivable are insured, your bank will treat them just like a domestic account receivable. They'll let you borrow against them. And so there again, back to kind of this, when we talk about the working capital, it increases your availability. You can actually, what was a dead asset on your books, a foreign account receivable, they'll now advance them just like they would a domestic account receivable, usually 85 to 90% advance rate on insured foreign accounts receivables. And there's another one of my videos at the bottom of the slide that you guys can look at. Talks a little bit about export credit insurance. So what is it when I talked about that 95% coverage? This is what I'm talking about. I'm talking about commercial risk and I'm talking about political risk. Commercial risk is, best way to describe that is something bad has happened to your buyer and they can't pay you. They've declared bankruptcy. They filed for insolvency. They're just a slow payer because something has happened in their business model to where they just don't have the money to pay you. That's commercial risk. That's covered under our multi-buyer products, 95% coverage. Under our single buyer, and I'm going to talk about the difference between those two here in a minute, 90% coverage on single buyer. Political risk. Best way to describe this is something bad has happened in your buyer's country and they can't pay you. You got the really bad ones at the top. You got the war, revolution, insurrection. That's when things just got really bad really fast in your buyer's country. Could be to where your buyer, something happened and he's lost the ability to import your product. He no longer can legally buy your product and take possession of it in country. So cancellation of buyer's import license, that's covered. Currency and convertibility, and I want to focus on this a little bit. This is not currency fluctuation. We all know what's happened with the U.S. dollar over the course of the past 18 months. Most currencies, the U.S. dollar has appreciated 20 to 25%. Mexico, I think we're in the 40s. Against some of the euros, against the euro and the pound sterling, I think we're in the mid-20s. Canadian, the mid-20s. That's fluctuation. I can't help you with that. That's where you call your friendly international banker at one of the commercial banks. They'll have an FX desk. They'll help you. They'll help your buyer. They will help mitigate that foreign exchange risk for you. They can't do anything about the fact that the U.S. dollar is on a tear, but they can at least help with the timing so that you and your buyer can lock in rates so that you don't get caught up in a wild swing from the point of order to the time that payment's going to be made. Currency and convertibility, we do cover that. And the best way to describe that is think West Africa is running into a little bit of a problem right now because the commodity markets are down, oil prices down, pretty much everything is down. And those economies are 100% based on commodities. When oil dropped from $100 a barrel down into the 20s, it's now at 50, so it's not as bad. The central banks in a lot of the West African countries, they ran out of money. And I don't mean that, I literally, they ran out of money. If you had a buyer in Nigeria that wanted to go to the central bank, convert the local currency, the Nigerian naira, into US dollars to make payment, the answer they got from the central bank was, well, get in line. We don't have any US dollars right now. Try again in 60 days. Now, luckily, we've never gotten to a point to where that 60 days turned into 120, turned into 180, turned into 360, to where our guys did not get paid at all. If that happens, and for whatever reason, the Nigerian naira it's no longer being converted into US dollars. Basically, they've turned the faucet off and the money's not leaving the country. that is something that is covered by us. So a little bit difference between inconvertibility and fluctuation. Here's the two flavors, as I like to call them. The multi-buyer, that's that 95% coverage that I mentioned, and then single buyers is 90% coverage. Multi-buyer, it's exactly what it sounds like. You're going to be setting up a policy to cover a number of your foreign buyers. It's really easy to set up one policy, and then you can put your different foreign buyers, layer them under that one policy. I've got 3 different kinds that I primarily use. We have an express policy, which is great for new to exporting companies or new to using export credit insurance companies, companies that are new to this whole concept of exporting on some type of an open account basis. It's kind of the junior varsity policy. It's a really good policy to get you started, get you understanding the process. And then within 3 years, our plan is to graduate you then into one of our other policies, which is either a small business policy, if you're a small business, or a standard multi-buyer policy. That's available to small businesses and large businesses. But the idea there is that we're going to have any number of buyers covered under one policy. We're going to build a premium rate, and we're going to talk premium rates in the next slide. We're going to talk premium rate of the multi-buyer policy. We're going to give you a blended rate. We're basically going to spread that rate and kind of price your risk based on where your insurance is going to be covered. The single buyer policy is exactly what it sounds like. You're not worried about all of your export business. You're just worried about that one particular, maybe a new buyer, maybe a buyer that wants a little bit too long to remit payment. He wants a little bit too much credit. Basically, you're comfortable with everything else you're doing. It's just that one buyer that you really wanted. Very selective risk is what that basically is. This is basically a single buyer policy, is you calling your insurance agent and saying, I know that I have my home and my auto and my rental property, my boat. I know that's insured with the guy down the street, but I have a 16-year-old son that just got his driver's license, and I would really like to insure him. Selective risk. There again, that's when the sweat breaks out on your insurance agents on face, because 16-year-old boys, they don't like covering those guys. But that's kind of what single buyer is. Selective risk. Just that one particular scenario pops up that you want to look at some coverage. We can do, and then there's a combination of those under the multi-buyer. Under that standard multi-buyer, we have what's called a reasonable spread of risk. It's where you can come at me with a bucket of your export customers and say, you know what, half of these guys I've been doing business with for 20 years. They don't scare me at all. But this other half, they're kind of new customers, or they're West African customers, or these are my Latin America businesses. I want to exclude Western Europe and Canada and parts of Asia. We can do that. We can customize a policy that fits your needs. Here's that premium that I was talking about. So when I visit with companies, the first question that I usually get is, are you really with the government? Because they don't believe that. They typically, what's the catch? This is too good to be true. I don't believe it. And then the next thing is usually, well, this has just got to be really expensive. And this slide is just, this is pricing for our small business multi-buyer. So this is one of my 95% risk coverages. If you look at the third column over where it says Class 3 Private, drop down to the 0.55 screen where it says from 1 to 60 days, 0.55. What that basically tells you is that if you're exporting, you're giving your buyer 60 days to pay. Your premium rate under my small business multi-buyer policy is 0.55%. On a $100,000 invoice, that's $550. It's not expensive. It's very cost effective, and in fact, most of my companies that take advantage of this, they pass that cost. So if you're giving 60-day terms to your buyer, a lot of my companies will covering their cost to me. I get 0.5 into the company Friday pizza fund or donuts on Monday fund. I don't care what you do with with your 45 basis points. That's fine. But if you're charging your customer 1% on 60 days, that's an annual cost of funds of 6%. Your buyers can't get 6% in their bank, in their countries at their banks. If you're selling into Latin America, they're lucky to get 20% cost of funds from their bank. So you're giving them a cheaper financing solution than what they can dream of getting in your country or in their country. You're protecting yourself, and the whole idea is that if you insure your invoices, and instead of cash in advance letters of credit, you kind of move to this open account philosophy. The idea is that your buyers are going to buy more. That's what it's all about. And the reason I'm in business is that if your buyers buy more, you're going to export more. And the more you export, the more people you have to hire. That's what we're all about as jobs. And that's why I'm going to talk about one of my rules is all about U.S. made stuff and services. I want to support services and products that are made in the U.S. by U.S. workers. It's all about jobs. So that's export credit insurance. Going to look at now this is our third core product. This is what we call our foreign buyer financing. This is, think capital equipment, and typically think deals over $250,000. What we can do in this case is, there again, we don't typically lend the money, but what we can do is we can arrange financing for your buyers. Your buyers in Latin America, effective interest rate is in the 20s. West Africa, 20s, 30s. Middle East, it's high. Eastern Europe, it's high. Parts of Asia, it's high. The banks, there again, remember, banks are not real liquid outside of the U.S., so they're charging a pretty good penny for cost of funds. Your buyer may come to you and say, hey, U.S. company, I really, in the case, there's a whole lot of cranes. I walk outside out here, there's cranes everywhere. So we'll say that one of these folks that I've been talking to, they run into a buyer that wants to buy their crane, but they say, hey, we really want this crane. It's $1 million, but we need you to arrange financing for us because we're from Argentina, and the going rate in Argentina right now is 4% per month or 48% on an annualized basis. Can you arrange financing? Hopefully, it's one of the companies I visited with this week, and they're going to call me because what we will do is we will arrange that financing. We work with a handful of banks here in the U.S. We work with banks outside of the U.S. The banks actually provide the financing to that foreign buyer. I step in with a 100% principal and interest guarantee to make the deal happen. You, as the exporter, you get paid a minimum of 50% down up front. That 85%, which is going to be our financed amount, that gets paid to you at the time of export. So you're going to submit documentation. You're going to submit your ocean bill of lading, maybe a third-party inspection certificate, purchase order, commercial invoice. You're going to submit that to the bank that's providing the financing. They're then going to pay you off. You're done. You get that 85%. It's a cash sale to you. You're paid at the time of export. You're off to the next opportunity. And what's left is that loan from the U.S. bank or the in-country bank to your buyer, 100% principal and interest guarantee from the federal government in place. And what that 100% principal and interest guarantee does is it drops interest rates. So there is, went too far. There's a slide that in some of the presentations I use, it kind of talks about the central bank rates thank you. There's central bank rates in some countries to where they're, Argentina, 4% per month. Latin America, I know Mexico's in the 20s. We can usually arrange financing at a third to a half of what's out there, what's provided in country. So this is when I say that export credit agency financing makes the world go round. This is what makes the world go round. It's not a widely used tool in the U.S., but 90% of the business outside of the U.S. revolves around export credit agency financing. There's not a deal that leaves the Eurozone that is not insured in some way through export credit insurance or doesn't have this type of prearranged financing in place. So the U.S., we're playing catch up a little bit, but that's okay. We'll get there. I think our next slide is our question answer slide. I do want, before we get into questions, I talked about some rules earlier, and I want to kind of look at our rules. There's 3 rules. Government agency, imagine that, we have rules. The first one is that U.S. content that I talked about. We like stuff and services that are majority U.S. content. So for the export credit insurance, you just got to meet me halfway, 50%. If your cost of goods sold for whatever you're selling, if your factory cost is $100 before you build in your profit, if it costs you $100 to make, just show me that 50 of it came from the U.S. Raw material, parts, labor, research, development, overhead. Just get me to 50%. I don't care if the little rubber buttons are made in Vietnam. I don't care if some of the wiring is made in China. That's perfectly fine. Get me to 50%. You're going to be just fine with me. The foreign buyer financing, we kind of raised the bar a little bit there. Ideally, we're going to be looking at projects. We're going to be looking at equipment that's at least 85% U.S. content. That's where that 15% down payment comes into play. I can't finance under the foreign buyer program. I can't finance non-U.S. components. So if it's at least 85%, I'm still going to get that 15% down. Let's say that your piece of equipment is 70% U.S. content. I can still finance that 70%. It's just going to require from your buyer a larger down payment. Instead of 15%, they got to pay 30%. In effect, they basically have to pay cash for the non-U.S. component, then I can finance the rest. So that's a little bit as far as content goes. Military, I can't do military. Things that go boom, I can't touch. And if you're selling to entities that like things that go boom, basically your foreign militaries, I can't touch them either. Even if you're selling something as innocent as Q-tips and cotton balls, if you're selling those to the Egyptian military, I can't touch that because it is considered a military transaction. There's a little wiggle room. There's, dual use comes into play. There's some gray areas to where we have provided financing to foreign militaries, but it gets a little tricky. And finally, our third rule, and I encourage everybody to go to this, it's our country limitation schedule. It's on our website, www.exim.gov. It's a really big spreadsheet, for lack of a better term. It's basically all the possible export destinations you could be thinking of, and then we detail if we're open for coverage or closed for coverage in those markets. There's not going to be many surprises on there. You're going to find your Cubas and your North Koreas and your Syrias and your Sudans. They're closed. We have trade sanctions in place. I can't help you. There's going to be other countries. Venezuela is the one that comes to mind. There's no trade sanctions in place with Venezuela. You can sell product to Venezuela until you're blue in the face. However, we're closed in Venezuela because we can't get comfortable with the credit risk in Venezuela. So my rule of thumb there that I always say is, yes, you can export to Venezuela all you want, but if the federal government can't get comfortable with the credit risk, I would recommend that a small, medium, large business in the U.S., you probably shouldn't get comfortable with the credit risk either. Get paid up front. That's where your cash in advance comes into play. You don't want a letter of credit from a Venezuelan bank. And you're not going to find, Exim financing or private sector financing. So that in a nutshell is my rules. That's my presentation. I guess we've got some time for questions and answers. So I guess I'll turn that back over to Kevin.
All right, perfect, Mark. Thank you. This was a great presentation. I know I learned, and I've had you in our office talking about this, and I still learned stuff today. So great job, and I'm sure it's valuable for the online. We've got about 20 minutes for question and answers, and we've got some good ones. Let's start where you just finished off there on countries at credit risk. One of the questions was currently what countries are the highest credit risk? Now you mentioned the blockaded countries, Syria, North Korea, etc., Cuba, and you mentioned Venezuela. What other countries and or region high risk, and are there any countries on there that might surprise us?
I can assure there's no countries on there that you're going to look at that and go, wow, I can't believe Exim Bank is closed in that market. I'll kind of give you an idea of some areas that we're kind of keeping an eye on right now, and I kind of alluded to it a little bit earlier. West Africa and the Middle East. We're still business as usual. Well, to an extent. We had to close coverage in Mozambique. But if you think West Africa and Middle East, very, very dependent upon commodity price. The drop in oil, frankly, a lot of the countries in those areas, they thought oil was going to stay at $100 a barrel forever. They set a fiscal budget for $100 a barrel. They assumed it was always going to be there. And when it dropped to 20 and $30, and now it's hovering around 50, you've got a lot of those economies that are in a cash crunch. We're keeping a close eye on that. West Africa, we're keeping an eye on Angola, Nigeria, Ghana, Cameroon, Cote d'Ivoire. We're keeping an eye on those just to see if they can kind of straighten the ship, if you will, after weathering this drop in commodity. And I know that some of the different commodities, some of the precious metals are coming back a little bit, but oil's the one that's really the trigger there. Middle East is kind of funny. Very dependent on oil. We have never, for the most part in the past, we've never been asked to assist with transactions into Saudi Arabia or the UAE. For the simple fact, you wanted cash up front, they paid you cash up front because they had plenty of cash up front. They were fine paying that up front. With this drop in oil and the fact that oil's kind of hovering around 50, they're keeping their arms around their cash a little bit more. They're not spending it as much as they were. So I've been asked to help arrange financing in Saudi Arabia. I've been providing insurance to buyers in UAE that we haven't done in the past. I think those markets are going to be just fine. I'm not going to lose any sleep over whether or not I think the Middle East is going to have issues. Africa, we are keeping a close eye on those guys. Russia, Ukraine, that's an interesting. If you go to my CLS, you will notice that we do not have X's on Russia and Ukraine. But if you look at our note, we have a note 12 on there, which says that we are an administrative hold. That's government speak to where we've basically put on the brakes. We haven't eliminated our current obligations. If you have a policy in place in Russia before the spring of 2014, before the trade sanctions went in place, you're fine with that. We haven't pulled and taken on any new risk. Just for the simple fact that there are trade sanctions currently in place with Russia. We got to keep an eye on that. And frankly, Ukraine they're having some issues. Russia, Ukraine, unfortunately, has kind of been going in the opposite direction. So that's some of the countries we're kind of keeping an eye on.
Okay, fantastic. What if I need capital to operate my business while waiting for payments overseas or sales to come in?
It sounded like the question was about access to working capital.
Yeah.
And that's where you're going to talk to your bank. And they're going to look at it. Also, if all else fails, there's also some what we call non-banks out there that do purchase order financing that will actually take you get a purchase order in from a company. They will actually, kind of a mini self-liquidating line. They may use my guarantee. They may use SBA guarantee, but they will actually put a true purchase order financing facility in place to where you get a purchase order, you borrow against that to go get the stuff that you need, you complete your sale, you get paid, pays down, completes that, self-liquidates that line of credit, under the true purchase order financing, which isn't something that banks typically are real comfortable with.
So the question is, I would like insight as to the trigger mechanism to collect bad debts.
Oh, okay. I can tell you what our mechanism is. So let's say that the way that we work is, let's say that you're providing a customer 60-day terms. Day 61, that customer is officially 1 day past due. Your clock is going to tick for 90 days. You're going to do whatever you would normally do under those 90 days to collect that debt. Now, if you get a notice of bankruptcy or insolvency, you're going to file a claim immediately because I want to get in line and work through the court system to get my proof of claim and get paid. But if they're just a slow pay account, you're going to do what you normally do for 90 days. Phone calls, emails. You might reach out to our folks at the U.S. Commercial Service. They may be able to get a letter drafted on our in-country embassy letterhead sent out to those buyers to kind of encourage a payment. If all else fails, day 90 hits. So they were supposed to pay on day 60. So add 90. So on day 150, they haven't paid. That's when your claim filing window opens with me. You file a claim, and you get 95% of what's owed to you. That claim filing window stays open for 5 months. You may, even though a company is now over 90 days past due, you may still want to work with them. It's perfectly fine. We allow you to work with them for 5 months. As we get closer to the end of that 5 months, we're going to start letting you know that you're getting real close to your claim filing deadline and realize you want to work with these folks, but it's been long enough now. File the claim. We'll pay you. You're going to sign that receivable over to me, and then we collect. And we do a real good job of collecting. I hope that answers the question as far as the trigger mechanism goes.
No, I think that answers it very well. And if anybody has any additional questions, they can always email us, and the audience is usually really good at that. And we would forward on that question to make sure to get it out on our YouTube channel and onto our website and things like that if the question's answered. So more of those come up after the fact. But so let me ask about the mingling of products. You have different services with the credit insurance, things like that you're selling. Is everybody kind of grouping those? Or is there when they're using one product with you, or is it typical for using multiple products?
Yeah, we have some folks that just use export credit insurance, and that's fine. The neat thing about that export credit insurance is, remember we talked about how your bankers look favorably on insured foreign accounts receivables. A lot of times what they'll do is they will fold those into the domestic line of credit that you already have with the bank, and just that added advance rate that they can provide to an insured foreign account receivable, a lot of times they'll be able to increase that line on your domestic line to the point to where you can borrow enough money. Some banks, if they can't get to that number, they will then, export credit insurance is still in place, they will still put an SBA product or an Exim product in place as kind of a carve out just to support those exports. The neat thing is that if you have an SBA export line of credit or an Exim export line of credit, and it's supported by my export credit insurance, by my insured foreign accounts receivables, we'll knock 25% off that premium. So the premium's already cheap, but we'll knock, for that example I used of 0.55%, we'll knock a quarter of that off, just as an incentive that you're using that insurance to support a line. So I see that a lot. I see a lot of equipment manufacturers that they'll use the short-term export credit insurance for their distributor network. When they're selling through distributors, they'll insure that short-term financing that they need. And then when they're selling their larger piece of equipment directly to the end user, they'll use my foreign buyer financing, where I can range up to 5-year term financing for those buyers. So yeah, I probably have some companies that pick and choose, use one. There's a number of them I can think, a few of them that I visited with already that they have 3 of our products. They've pretty much, they've gone across the board and they've have a little bit of everything from me.
Perfect. We always like those customers, right?
Yes, we do.
Here's one that's, and I think you've answered these 2 questions, but just to, again, I want to make sure that we're providing the viewers the value that they come in for. It says, I'm interested in currency valuation / exchange and obtaining credit references from foreign countries. That's something you do.
Let's talk about the foreign currency first. There is, if you have questions as far as your exposure, what the potential exposure is, how you're going to, if you're going to price your product in a foreign currency, highly recommend you get in touch with your commercial bank that you work with. they will have a foreign exchange desk. If you're dealing with a smaller bank that maybe doesn't have a foreign exchange desk, they'll know who to call at their larger correspondent bank that they work with. So I would, any foreign exchange questions, I did that for a dozen years in my pre-joining the government world. I'm not going to tell you that I'm the expert on foreign exchange, but luckily that's what commercial banks do. As far as credit references, there's a number of credit bureaus that we use. That's one of the tools that we use when we evaluate your foreign buyers. COFOS has a good product. Kreller has a good product. They're out of Cincinnati. And then Gradon, I believe they're up east. They do a good product. There's a company called Globiz. They're out of China. They are, if you want to need to get a background on someone in China, Globiz is great. The U.S. Commercial Service has a couple products. They have their international company profiles to where they will get good background information on your buyers. Now, these are not cheap. A good credit bureau can run you $200 to $250. The international company profile with the U.S. Commercial Service, they're a little bit more expensive than that. But this is going to be a very complete. If you order one of these through one of these companies, I don't have that product, but you're going to get a really good profile of your buyer. You're going to get trade references are usually embedded. Most of them will have some type of financials embedded in those. So if you invest a little bit of money, a couple $100, you're going to have a really, really, really business with.
All right, perfect. So another question here is, I think this is specifically, it says, is there a payment guarantee service from overseas buyers if we pay a percentage fee to a bank or company? We are concerned about not getting paid in time or buyers defaulting on the payment.
So final question that we just had, that's exactly what our export credit insurance is. You pay a premium to me, and we provide that risk mitigation to where you're going to sleep at night.
All right, perfect. Mark, I've got a question for you, and again, because this interfered with, this negatively impacted a lot of our clients when Exim Bank was not authorized by the government. Can you talk about that process and what our listeners should be doing every day or keep in mind as it relates to the authorization of the Exim Bank?
Yeah, it's just to kind of give you a background. We are what's called a sunset agency, which means that every 4 to 5 years, Congress votes on our right to continue doing what we do. We've been reauthorized now. I think this last time we were reauthorized, this is our 18th time that we've been reauthorized since 1934. We did have an authorization lapse from July of 2015 through December of 2015. We were still open for business. We just couldn't take on any new opportunities for 5 months. Our authority to take on new obligations lapsed. It is what it is. I don't have. It's just sometimes, Congress. You live in a democracy, and sometimes things happen. I can report that we are back. We are reauthorized. We're good through September 30th of 2019. Some latest news coming out of the new administration is that President Trump is supporting Exim Bank. He supports our mission. He supports how we're helping. He understands a little bit better now than what he did pre-election as far as what we do for the small businesses. Yes, we help Boeing, but that's not what we're all about. So it's all about what we can do for small businesses, help grow exports, help small business, help America, be American, buy American, all that kind of good stuff. He's assured us that, part of this with the new administration, I'll get a new chairman, so I'm going to have a new boss here within the next couple of months. And he's assured us that he's going to get our board completed. One of our problems that we've been having is that we have not had a board quorum since we came back from lapse. which limits what we can do over 10 million. Anything under 10 million, business as usual. But for the larger projects over 10 million, I need a board quorum to approve those. I don't have a board quorum right now. So the new administration has assured us, in addition to the new chairman, we're also going to get our board. We're going to get back up and running at full strength again, and things will be back to normal again. It was purely, we have an overwhelming majority both in the House and the Senate. It was just the reason that we lapsed for 5 months, purely philosophical. Small business is good business, and it just so happened we were a sunset agency that just came up for reauthorization at the wrong time. So, but we're back up again.
Good, good. Well, I just wanted to get that out there, make sure everybody knew, because I know that did negatively affect, because everybody wants the services that you offer, and that was the difficulty when you weren't authorized. It wasn't your fault, but it negatively affected folks that were wanting to, especially many of our clients that depend on your services in order to boost and promote their services globally. So, it told me how valuable Exim Bank is to the export community, and two, that we need to make sure that we participate and our legislators as it relates to the value of Exim, make sure that it continues to get reauthorized at the time that it's getting ready to sunset. Anyways, I wanted to make sure that everybody understood that and got that out. So we are at the conclusion of our presentation today. It is almost 2:30 Standard Time. Mark, I appreciate your partnership and you joining us today to shed some light on your products. I know it's one that we promote a lot to our export clients. Thank you for taking the time out of your travels and your busy schedule to join in with us today.
I appreciate it. Thanks for letting me participate, and apologize for a little bit of the background noise and my wonky internet connection here. But I think it's a good presentation, and thanks for everybody that dialed into it.
You bet, and I would like to thank everybody again for joining us today. We look forward to visiting with you at future webinars. Should you have any questions regarding this webinar, please do let me know. Email us, and we will get back to you. You will all get an email with the presentation, the audio, and links to the questions and answers. And we look forward to a good 2017 with all of you. Take care.